So I thought we might get started. My name is Kevin Batterton. I'm a managing director at Sterling Trustees, which is a completely independent trust administration company based in Sioux Falls, South Dakota. We also on the line have our president and CEO, Anthony Jaffe. We'll be happy to take your questions at the end of the presentation. I believe Stephen and my email addresses are available in case someone needs to contact us with questions afterwards. Feel free to. Stephen, this is truly a world gone mad, and thank you for joining us. For those that don't know Stephen Liss, he is a distinguished partner at the firm Schiff Hardin in New York City, and happy to have him with us today. Stephen, during these turbulent times, I mean, what should we be thinking about, and what opportunities exist for our clients?
Thanks, Kevin. Yeah, I think the biggest thing for us to remember as advisors is that this too shall pass, right? It's definitely a bit of crazyville out there still, but if we take a moment and we think about what the world's going to be like in 6 months or 2 years or 10 years from now, I think it's a little easier to be optimistic and therefore to think about, given everything that's happening right now, what opportunities can we remind our clients about so that they can take advantage of them and be in a better position to achieve their goals. We live in a time or at a moment when we've depressed and very volatile public equity markets. Last week in a 3-day period, both the Dow and the S&P 500 surged 20% in 3 days, which was the largest increase over a 3-day period since 1931. So that's 90 years. At the same time, Friday the markets went down another 3.5%, and today they were up a little, down a little. So that's just the reality that we're living with. We do have historically low interest rates, and as an estate planner, when I talk about interest rates, I'm talking about the applicable federal rate that the IRS publishes every month and the 75/20 rate, which is used by the IRS to do present value calculations for various estate planning techniques like GRATs and QPERTs and charitable lead annuity trusts. And this coming month, April, so tomorrow, that rate will be 1.2%. And the only time it's ever been lower was back in 2012, it hit 1% for 3 months. And in January of 2013, it again hit 1%. So this really is as low as it's ever been. And when we look over at private assets, real estate, privately held businesses, once again, if people would plan with those, if they would make gifts of those today, when an appraiser got done doing their work and telling us, well, what was the value of that gift, they're going to look at the macroeconomic environment, and they're going to look at all the uncertainty that we're living with at this moment, and they're going to come out with a much lower valuation than they would have 3 months ago, and a much lower valuation than we hope the business or the property would reflect in any reasonable period of time going forward. And of course, we still have really high gift and estate tax exemptions. So as crazy as it is right now, it actually is a really good time to do some planning. And if you don't mind, Kevin, I'd like to just spend just 2 minutes. I want to talk about a couple of things that are even a little bit new since we first discussed doing this webinar, which is the CARES Act that just passed last week, and some of the things that have been happening with tax filing and payment deadlines. So we're not going to do a whole presentation on that. Obviously, we only have about 15, 20 minutes. We want to give everyone a chance to get back to their day, but a couple provisions on the CARES Act that came out that you're going to start seeing a lot of materials coming into everyone's inbox. The first is for 2020, if people need some cash, they can tap into their IRAs. They can take out up to $100,000 without paying the 10% early withdrawal penalty. And they have 3 years to put that money back into their IRA. It is supposed to be used for something that's corona-related or a corona-related purpose, but that's so broadly defined that the vast majority of people who need that help are going to qualify. On the flip side, if you're someone who is still financially secure, and you're over 70 and a half, you don't have to take your RMDs for 2020. No required minimum distributions from IRAs for 2020. So that's a way of keeping a little extra money in this market working. And if you're looking for ways to help others, even if you don't itemize your deductions, and after the Tax Cut and Job Act, a lot of people don't, you can give up to $300 of cash to a public charity and deduct that on your tax return this year. And if you want to be more generous, usually there's a limit of 50% of your adjusted gross income, which is the maximum charitable deduction you can take for cash gifts to public charities. That has been waived for 2020. So you can give as much cash as you want to a public charity, fully offset your gross income. You can actually pay zero income tax this year as a result of doing that. It does have to go to a public charity, which does not include a donor advised fund. So for most purposes, DAFs are public charity, not for this extra benefit. And then the last one that I'll point out, the employer share of Social Security tax, that's the 6.2% that employers pay, as well as self-employed people, that is being deferred. So you'll pay half of that in 2021 and half in 2022. Again, that's just a way of keeping some extra cash in the economy. But that can prove to be very helpful for a lot of people.
So Stephen, this would be, for example, we have many clients that are entrepreneurs. They might be in the restaurant business, so they can use their IRAs to cover perhaps some of the lost income from those entities?
Exactly. It's useful for, it can be used for anyone who, if they're diagnosed or their spouse or dependent child is diagnosed with COVID-19, if they have any adverse financial consequence due to being quarantined, being furloughed, laid off, having reduced work hours, or if a business owner has reduced business hours due to COVID-19. So as I said, it's very broad, and a lot of people can take advantage of that if they just need that short-term loan to carry them through either for personal expenses or for their business expenses.
Great, thank you.
Quickly on tax filings, this has been changing very rapidly. So at the federal level, it's clear now that for income tax purposes, you don't have to file on April 15th. You don't have to pay on April 15th for income taxes or your first estimateds. Those are all delayed automatically until July 15. And just Friday, another notice came out granting the same relief for gift tax returns and the payment of gift tax. But that's not everything. There's a lot of information reporting that at this moment has not been extended. So if you own any foreign financial assets, 3520 is 5227, 8938, none of those forms have been extended. Similarly, if you're a charity, 990s, 990PF, those forms have not been extended. It's possible we'll get more relief, but at this point, you really need to look at what forms you're required to file and see if the automatic extension to July 15th is going to help you. The best advice is probably to just go ahead and file an extension if you can, in order to guarantee that you have an extension all the way through October. And on the state side, again, most states have extended tax filings through July 15th. My understanding is New Jersey has not yet, but that something did pass and that the governor's supposed to sign it, but I haven't seen anything that's been finalized at this point. So again, at the state level, check to see what's going on with your particular state and with the particular forms that you are supposed to file.
So I guess I don't know what everybody is seeing, but what we're seeing at Sterling Trustees is a sense that accountants are pushing returns forward to meet the original deadline of in April, and I guess there's a sense that they don't want a backlog of returns when the extension expires. And probably clients are wondering how much, what is the real value of cash? What are they going to save at the end of the day? So we see a push forward to, file returns on a timely basis as if nothing had happened.
I think to a certain extent that's right. For all of us and everything we're doing, the more business as usual we can live our lives, the better it's going to be. So if you can file your tax return, go ahead and file it. If you can file an extension, if you have the ability to generate that document and to stick it in the mail, it's a one-page document. I think you're better off doing that than relying on the sort of ad hoc relief that's coming out of Washington. It's not that Treasury and the IRS aren't trying to do everything they can, but I think even they don't realize just how many forms exist and how much how much relief would need to be granted in order to extend everything. So if you can do it the normal way, it's always easier if you've done the normal way than the emergency route, and then rely on those extensions as a backstop in case something falls through the cracks.
I would agree. So Stephen, you had mentioned earlier, everyone is obviously concerned about declining asset values and interest rates are at historical lows. But, there obviously is a silver lining, from a planning perspective. What can be done?
Yeah, and there's a lot, and I think a lot of people, just as human beings, this week, I think, is when people are going to start picking their head up a little and looking around and saying, what's going on? They've been started to work remotely. That was very unsettling for them in their business life. They've been dealing with children who suddenly were not in school all week long, and they were trying to get them set up. They were taking care of spouses, grandparents. And I think this is a week where people start picking their head up and looking to their advisors and seeing, what can I do? They've certainly been talking to their financial advisors, but now I think they're going to start having a little bandwidth to deal with a broader range of issues, and there are opportunities. So, I always like to tell people, economically, all estate planning comes down to three things. There is time value of money, right? Make a gift to a trust, let it grow out of your estate instead of in your estate. There is leverage. Be the bank of mom and dad. Lend money to a trust, lend money to your kids. Again, as long as those assets grow faster than the interest rate on the loan, you're having family wealth accrue someplace where it's not going to pay estate tax instead of in your name. And finally, there's discounts. If you have a hard-to-value asset, an appraiser can give you an attractive valuation, and you can use that valuation as the basis for your transfers. So time value of money, leverage is just a way of speeding up time value of money, and discounts. Every estate planning technique economically can be broken down into those three parts. So GRATs, CLATs, IDGITs, CUPERTs, SKINs, the whole alphabet soup of estate planning. But to focus in on a couple of those, GRATs are grantor retained annuity trusts. They are still the workhorse of estate planning. It's the most commonly used technique, and given time, I'm not going to really go into the details of how a GRAT works. But right now, with public securities still at highly depressed values, now's a great time to do GRATs. If you still own airline stocks and you're not going to sell them, put them in a GRAT. I don't think anyone's going to be surprised. I want to be careful how I say this. It would not shock the universe if an airline went bankrupt because of how much that industry is suffering because of Corona and all the fallout. If they don't go bankrupt, is anyone going to be shocked if airline stocks are worth double or triple what they are today, 12 or 18 months from now? I don't think so. So if you're going to keep it, if as an investment you want to keep it, put in a GRAT, and all the growth over 1.2%, because that's the 75-20 rate, all that extra growth is going to pass down to your kids estate tax-free. Also, look at existing GRATs. A lot of them are currently failed GRATs, meaning the annuity payments that remain are higher than the fair market value of assets in the GRAT right now. Do a swap. Take the equities out of that GRAT, put in cash, put in treasuries, put in a promissory note, and create a new GRAT with those equities at this 75-20 rate, which is almost certainly lower than the old GRAT, at this valuation, which is lower, And if it goes up over the next 2 years, you'll move wealth out of your estate. Another thing I would look at is intrafamily loans. And these come up in a lot of different settings. Parents lend money to children. Grantors lend money to grantor trusts to try to increase the size of the trusts. But you can also, if you have a GST exempt trust and a GST non-exempt trust, what can we do to get more money into that GST exempt trust? Well, maybe the non-exempt trust lends money and charges 1%, which is the applicable federal rate for a 9-year loan as of April 1. You can charge 1% interest. And if those assets grow by more than 1%, you're moving money from your non-exempt trust into your GST exempt trust. And that will save the family a lot of tax over time. You might also want to refi. If you already have some intrafamily loans, look at the interest rate. It might be a lot lower in April. You can refinance those, just like people do with real business loans. You're in year 6 of a 9-year family loan. Refinance it using the current lower AFR. The other thing I would tell people to look at is GST exemption. Some clients will not want to make gifts right now because they are feeling economically vulnerable. So they don't want to use their gift exemption, but they have GST exemption. And if they have non-exempt trusts, do a late allocation. Make that trust a generation skipping trust. If it doesn't run long enough, maybe you can decant it and stretch it out. So now it is more of a dynasty trust, and you can allocate GST exemption to it, and you're allocating at today's valuations. In a similar vein, again, look at those hard-to-value assets of real estate or business interests. Transfer those to a GST exempt dynasty trust. There's probably never going to be a better time. And if you're worried about valuation, you can use something like a Wandry clause or some sort of other formula clause to make sure that you don't go over the valuation, over your gift tax exemption. So those are just a couple of the estate planning side of things. Kevin, do we have a minute? Should I talk about Roth conversions and capital losses?
Sure.
Okay. So Roth conversions are another thing to do when asset values are low. In fact, it's something my wife and I are personally looking at right now. We have both traditional and Roth IRAs, and we might do at least a partial conversion of some of that IRA money into a Roth. And 2 things to remember there. One, you used to be able to do what they called recharacterize a Roth conversion, meaning you could do a Roth conversion and you had until you filed your tax return next April or next October in order to, and you could change your mind and undo that. That is not the law anymore. Once you make a Roth conversion, that is it. You cannot undo it. So keep that in mind. The other is after the Secure Act, unless a spouse inherits an IRA, almost everyone else has to take out inherited IRA money within 10 years. So you don't get quite as much deferral on a Roth conversion as you used to. They can still make a lot of sense, especially for younger clients. But you need to look at the math and decide, does paying the tax today, is that going to justify, is that going to exceed, does paying the tax today better, because that way you get tax-free growth for the rest of your life and for 10 years of the lives of those who inherit those assets. In terms of capital losses, obviously stocks are beat down. You might want to sell and capture that loss. Capital losses are a tax attribute that never expires. You can carry it forward as long as you need, and it will offset gains in the future. You do need to remember the wash sale rule, which is that if you bought the same asset 30 days before or 30 days after you trigger the loss, you won't get the benefit of that capital loss. Working with a good financial advisor, you can navigate your way through that. So for example, you own Coke, you're in a loss position on Coke, sell Coke, buy Pepsi, right? It's not the same thing, despite what billions of dollars of advertising over the last few decades have tried to make you think. The companies are not the same, but they are similar, and maybe that's good enough for your investment purposes. Your financial advisor can can walk you through that.
Stephen, these are all great planning ideas. I know we at Sterling Trustees are getting a lot of calls regarding contributing low basis stock. So there are lots of ideas for clients that are suffering either in their own business, valuations declining, or in their investments, valuations declining. There are certainly points that they should be considering.
Yeah. A couple last things. I want to bring everyone back to 2012. So in 2012, we had a $5 million gift tax exemption, but it was scheduled to drop back down to $1 million. So people thought they had to use their exemption. They weren't sure if they wanted to. They were looking for some flexibility in that gift. A couple of those strategies that were developed at that time may be relevant now. So one is the creative use of disclaimers. In other words, you make you can make a gift and say that if the person who receives the gift disclaims it, it will go to someone else. So just as a quick example, you give $10 million of your personal assets to your spouse. The deed of gift says, if my spouse disclaims this, the assets will go to a trust for my children. Over the next 9 months, you get to watch and see if those assets appreciate in value. If they do, execute the disclaimer, and you will now move $11 or $12 million worth of assets into trust for $10 million of gift exemption. If assets stay about the same or they go down in value, don't disclaim. You've made a gift to your spouse. That is a marital deduction. You've used no gift exemption, no harm, no foul. Similarly, you could make a gift to a marital trust, and you have until you file your gift tax return next April or October to make a Q-tip election. If you make the Q-tip election, you get a marital deduction for that gift. You've used no gift exemption. If you don't make the Q-tip election, that trust, even though it looks like a marital trust, mandatory income to spouse, spouse is the sole beneficiary, that is a completed gift. You do not qualify for the marital deduction because you did not make the Q-tip election. And you've now moved money into trust that you had a chance to wait and see it has in fact appreciated. So those are great strategies for someone who's not sure if we've hit bottom. They're not sure if they want to make a gift today. If you do want to make a gift, but you're just not sure that this is the day, March 31, maybe that's not the day you want to make it. You think sometime in the next 2 weeks, you could transfer assets to an incomplete gift trust. It usually takes a couple of days to a couple of weeks to transfer assets, depending on how complicated they are. So create your trust, get it funded. You retain certain powers that make it an incomplete gift. And when you're ready, go ahead and release those powers. And all of a sudden that becomes a completed gift and you're using your exemption at that point. So that's a nice little bit of flexibility. I'll also say that somebody recently pointed out to me on life insurance, it's very likely premiums are going to go up because coronavirus was a risk that was not accounted for properly in pricing the policies. And maybe more importantly, insurance companies' equity portfolios came down just like everyone else's. They're suffering from low yield on bonds just like everyone else is. And so they will have to change their pricing in order to adjust for that. So if you have an offer out for life insurance right now, you may want to move ahead and get that implemented just as quick as you can.
Yeah, that's smart advice, Stephen, because, we don't know, where the bottom is in this market. And certainly people should jump at opportunities that come their way. Mm-hmm. We'd like to thank you for your time today, Stephen. Certainly you've shared some great ideas and great thoughts, and we'd like to thank everybody that's joined us for this webinar today. I do apologize. I know we've had some technical difficulties, but if anyone that can't or hasn't been able to see the slides, we're happy to send those to you again. You could reach me at Kate Batterton at sterlingtrustees.com or sliss at schiffhardin.com. Thank you again, and thank you, Stephen.
My pleasure.